Hey folks, putting together a general market update video today where we're going to make sense of Friday's price action and the indexes and really the broader market in general, discuss its significance, and also revisit the market internals that we discussed in Thursday's video to kind of reaffirm how they could act as a precursor to price when at extremes. Then I'm going to kind of talk briefly about the mega caps, where they stand as of right now. Always important to keep an eye on these names because of their influence on the broader market. They make up almost 50% of the QQQ index alone. And guess what? The tech sector makes up almost 25%, correct me if I'm wrong, of the S&P 500. So it's safe to say where these tech giants go, the rest of the market is likely to follow. Then we're going to wrap it up by looking at my watch list of current relative strength leaders that I plan to trade if this rally does start to get legs. Kind of discuss a plan of action if looking to get involved, how we could do so this upcoming week. So let's start with the QQQ. We went from almost down 1% to a 3% melt up. So let's have a look at what transpired on the daily time frame and share its significance in the view of my eyes. So first things first, we broke out of a double bottom base, double bottom reversal pattern. We also had what's referred to as a wedge pop, which is our first close above the 10 and 20 exponential moving averages and the cycle of price action. And this serves as the start to a fresh bull cycle. We can also add into that mix that we broke out of a stage 1 base on the shorter term time frames. This is based on stage analysis and using the 195-minute time frame. So you could use stage analysis where it's primarily focused the weekly time frame to identify longer term trends. But as intermediate term trend traders, we can also use the shorter term time frames to help keep us on the right side of the market. Finally, the cherry on the top was that we got a follow-through day. And this is a CAN-SLIM term that signifies the start of a new rally. And it occurs when either the S&P 500, the SPY, or the QQQ close up 1.25% or more from the previous day's close and on volume heavier than the day prior. Now, this doesn't necessarily mean that we're going to go to all-time highs or anything like that. We don't get too excited. But, and to kind of point out, the most recent one actually failed. So it doesn't mean that we're always just going to rip higher. But something that is to be noted is that if there's ever going to be a significant market rally, it's going to always have started with a follow-through day. In fact, there's never been a major rally that started without a follow-through day as the initial move up. So to kind of make more sense of that, if we take a quick look back on the chart, we have a follow-through day here in May that started this rally. Really, it's where it all began. So you can see we closed up over almost 3% that day, and on volume higher than the day prior, and that resulted in that's a 21% gain in the index. This is an absolutely insane move up. We also had another follow-through day here on the 16th. We broke out of this what I refer to as a 3-touch trendline break shaper pattern. So these are like the launch pads for next leg up. But we had a follow-through day here, which resulted in if we use the high, it was only about, but a 5% move in the QQQ. So not as sizable of a gain, but it certainly served as a bullish indicator nonetheless. And then finally, we have our follow-through day that really marked the bottom of the bear market and led the beginning of the current bull market we're in, where we moved up on the day almost 3% once again. The volume was higher than the previous, and this led to a pretty sizable rally of about 17%. What also occurred at this point in time was we broke out of a stage 1 base. For those that are familiar with stage analysis, I'll pop the chart up at the top right. And that's really where I was increasingly bullish at that point in time. Everyone was bearish during this correction, but you come off of a almost 21% move in the indexes. You better believe there's going to be some sort of correction. We found support in the right area. We bounced off with a 5200. Everything was really lining up for higher prices, and that's what ended up panning out. But with that said, the reason I'm showing you how these previous follow-through days panned out is for no reason other than to highlight their significance. In the end, anything we use as market technicians is really just theory, and the best way to build confidence behind any specific tool or concept is to study previous outcomes, how things panned out historically. So with that said, we got our follow-through day. It's clearly not something to discount. And just one more thing to add, note how on each of the follow-through days, let's just look at the most recent one, that we had what's referred to as range expansion. So every stock or index has an average daily range. So this is the average daily range for the QQQ based off the last 20 days. It's 1.5%, give or take. If price were to close above that range, and this is, by the way, measuring from the low to the high, if it were to close above that ADR, it's giving us what's referred to as range expansion. And why that's important is because that's a sign of a momentum shift in the direction of that bar. When you get range expansion, and it's a big bullish bar, so one that has a very long body with very minimal wick, similar to here, similar to basically every follow-through day that we've received, that is what's called a trend bar. And the only buyers with enough liquidity to create these trend bars are institutions. And these are the lifeblood of the stock market. So our goal as traders, whether it be day traders, swing traders, position traders, or just investors, is to always align ourselves with institutions, because in the end, they're the ones that truly will move a stock up or down. If there's no institutional interest in a particular stock, that stock will not see higher prices. There will be a lot more supply in that name, and because of that, it will be in a prolonged downtrend. With that said, a follow-through day is a pretty big deal. Perceive it as more of a short-term signal. However, you can have consecutive follow-through days that kind of reignite the current rally and give more reason to be optimistic that there's going to be higher prices before you have another substantial consolidation period. So to conclude, Friday was pretty bullish, man. Now, in terms of significant resistance levels, we should be cognizant that we have a gap resistance right here, which is right about where the QQQ closed. Whenever a stock or index gaps down, like we saw right here, and leaves that gap unfilled, it can act as a significant resistance level when price eventually retests it. So I consider that resistance to be cleared once price moves above it and closes above it. Now, we just barely did that, so I wouldn't be surprised if on Monday we see some kind of digestion sideways before taking that with some conviction. Now, just overhead, we have the 50-day moving average. This is referred to many CANSOM traders and legendary hedge fund manager Jim Roppel as the institutional average. Why? Because if a stock is above that 50 moving average, it shows it has institutional support, whereas if it's below, lack thereof. So because of that, it's perceived as being a very significant level. It's actually a dynamic indicator, which means it never stays in one place. It's constantly moving. But this area is one that should be closely watched, as it could potentially act as a brick wall, similar to what we saw back in August, where you ran right up to that 50 and just got a huge rejection. Also, the slope of that 50-day moving average is declining, which just makes it more potent and likely to act as a resistance. However, the decline is quite minuscule. It's pretty almost flat, but something to note. So you have this 50-day moving average as resistance in the same area as this horizontal resistance area. So remember, support turns to resistance. So because we have two technical elements, overlapping one another, that's referred to as an area of convergence. And that's just fancy terms for saying that it's more than likely to hold as resistance. And let's talk a little bit more about that. Think of it this way. There are different groups of traders who trade, some trade only with moving averages, some purely price action, others only trend lines, etc. So when you have a horizontal level that coincides with a moving average, you have more market participants watching that area. Because of that, you tend to see a stronger response from price due to the increased amount of traders who stand to lose money when getting involved. And because of that, you get a heightened emotional response, which tends to lead to an increase in volatility. So with that said, this 368-ish area, I'd say 369 to 367-ish is going to be the next significant resistance, and then followed by this downtrend line at 373.5. That's as of now. It will change in a couple of days because that trend line is obviously moving lower with time. So what could be a resistance of 374 today, give it a week, it could be 372. So then we have the 368 level that stands as the next obstacle for the bulls. And that's really where we stand with regards to the Qs right now. Ideally, we would not want price to fall back below this base area. However, as long as it holds above the 10 exponential moving average, we're doing just fine. Sorry if I kind of Batista bombed you with technical terminology there. I know that may have been a bit overwhelming, but it's going to help you improve your ability to interpret what the chart's telling you, which is going to lead to better trading decisions and therefore more money that you make. So it might prove to be useful to rewatch certain parts of this video to really help it stick. Now, in terms of the S&P 500, the picture is not quite as, well, I would say it's still kind of leaning more bearish than anything as of right now. It was nice to see this big bullish bar engulfing, the previous 4 days. Also on a pickup in volume, but we do remain below this 20 exponential moving average. So using our newfound knowledge in levels of convergence, we can see we do have a resistance level here that coincides with this 20 exponential moving average. So we could have a powerful response off of this 432 area. That's really what we're focusing on. That would also be a double bottom breakout. And really the next level of resistance would be right over here, this gap high. And that will likely, by the time the price does, if it does break higher, be just about where the 50 moving average is going to be if it continues to decline at this rate. So this will be another level of convergence. So there's a lot of overhead that the indexes need to get through. Really the levels to focus on right now are 432 and then 438. We want the S&P 500 to hold above this 10 exponential moving average, but if the QQQ pulls back, this is likely going to lose that. So this is going to be interesting to see. You can see the 200-day moving average is just below that, acted as support. It's getting now kind of squeezed between the 20 and the 200. So we'll have to see. Time will tell with this one. Kind of just in a range still here. Now let's move on to the small caps. You can see they're even more beat up. They're still below that 10 exponential moving average and 20 exponential moving average. You can also see that these two moving averages are still fairly wide from one another. So when momentum is starting to dwindle to whatever direction the trend currently is, you're going to start to see them they're going to contract. And that's going to show that that momentum is kind of switching directions. We're actually even wider now this week, at the end of this week. So a lot of repair that needs to be done here. You have a potential death cross, which is a 50, when the 50 crosses below the 200, that is more than likely going to pan out in the course of the next 2 weeks, which is also a long-term bearish signal. But, we had one right here, ended up going higher, had a golden cross and went nowhere. So if you just look at the weekly, it's just stuck in a range. So those death crosses, those golden crosses, really not all that significant because we are stuck in a range. So moving averages now are reliable while price is range bound, while it's directionless. So don't take that for too much to be too significant. So all in all, S&P 500 IWM closed the week still bearish. SPY clearly a little bit of a pickup versus last week, which is nice to see. QQQ, the clear leading sector. If we're going long, we're focusing on stocks within this sector because they're showing the most strength. Now, let's move on to the mega cap names. Actually, let's first take a look at the market internals. I want to just review this. So we had a look at this over on Thursday night, and we discussed the McClellan oscillator and what it was kind of telling us at that point in time. We also compared the previous outcomes from when the McClellan oscillator broke through its downtrend. So you could have a downtrend on the McClellan oscillator, just like you can have a downtrend when looking at a technical chart. And when it breaks above that downtrend line, it's perceived as being a breakout, just like a technical chart. I use the MACD for my McClellan oscillator, which I feel pairs very nicely with it. You can see it coincides with that breakout in almost every instance. Not always as pretty, but pretty reliable overall. So we have the McClellan oscillator. This is what measures the current technical conditions with regards to being overbought or oversold. The more oversold this indicator is, the more likely we're to see at least some sort of bounce. When you break the downtrend line, you're going to have usually a pretty strong move to the upside. That's what's panned out. I'm just going to show one or two examples because we did go over this on Thursday, so I don't want to bore those that already saw. But we had a cross. You just have to take my word here. We had a cross in January, early January, which was right here, led to higher prices. We also had a cross in late March, right here. Every time that it's crossed from being in market extremes, we found higher prices. Now, I'm not saying we're going to all-time highs or anything like that again, but what I am saying is there's a fairly good track record here. And when you pair the oversold conditions from the technical side with poor market sentiment, pessimism that we see in the fear greed, it increases the reliability even more. Why is this? Because turning points are found at market extremes, whether it be extreme greed or whether it be extreme fear. And we are currently very pessimistic, or we were last week, and we were currently very sold as well, oversold as well. So on Thursday, we were right here, and I said we could potentially see a strong move to the upside in the coming week because of the current level of extremes that we're at right now, and based off of how I viewed the technical characteristics of QQQ at that time. Only reason I'm showing this is because I think it's very powerful to pair your technical analysis with market internals. This is kind of like looking under the hood of the market. And when you can look under the hood and it aligns with where you see the market going based off of the technical action, it will give you a lot more conviction and just make you a little more decisive when price action does move the direction you kind of anticipate for it to. So enough of the market internals. Let's now talk about the mega cap names. And these are just important because where the mega cap names go, the rest of the market is going to follow. They're just extremely heavily weighted in the indexes. So all we're going to do here is we're going to take a look at the 195-minute chart. And on the 195-minute chart, I have pictured here the 30 moving average, the simple moving average. And I'm going to actually get rid of this for simplicity's sake here. And all we're doing here is conducting stage analysis, but on the smaller time frame. So it's primarily done on the weekly time frame, but I have learned over time that you could use it on the smaller time frames, and it could be fairly useful for an intermediate term trader. So you can see here that price broke down from this consolidation range, and at the time it broke down, the 30 moving average started sloping down, confirming that we're now in a stage 4 downtrend. And then we got a relief bounce where we were then rejected at the moving average, the declining moving average, and that's the first sign that the market is finding some sort of bottom. We could have either consolidated here and broke lower, we could have gotten rejected and just fell lower, or we get rejected there, we put in a higher low, and price starts to kind of contract, and then eventually breaks out of this base. And when it breaks out of this base, if the moving average is curling up as well, which it is beginning to, we have a stage 2 breakout. So we have a stage 2 breakout on the QQQ, which is good. So the intermediate term direction, 1 to 3 weeks, is currently to the upside. Now let's take a look at all of the heaviest weighted names and see where they stand. And the way I look at this and why I keep track of it is because if 3 or 4 of these names are in stage 4 declines and 1 or 2 is in a stage 2 breakout or a stage 2 uptrend, the likelihood that the market is going to see further downside is going to be increased because of the amount of stocks in this basket that are showing weakness. So let's tally that up real quick. Microsoft broke out into a stage 2 uptrend. Okay, that moving average is sloping up. It broke out of the base and currently in a stage 2 uptrend. Apple, stage 2 uptrend. Google, stage 2 uptrend. Amazon, stage 1, had its first rejection off that declining moving average. Now it's kind of just consolidating. Can it hold this higher high and then resolve higher, giving us a double bottom breakout and then a stage 2 breakout? We'll have to see. The next major resistance would be 135 if that were the case. NVDA, stage 2 breakout. It's not as picture perfect here, but really it was right here where it broke out. Meta, stage 2 breakout. Tesla, stage 2 breakout. Netflix, this is really not even that heavily weighted. I'm not sure why I even have it on the list, but it's now in a stage 1 consolidation with earnings right around the corner. That's another thing. Earnings are right around the corner. So I think that the catalyst we received on Friday, the jobs report, I don't know why it was perceived as bullish, because really it was hinting at more potential rate hikes, but I don't argue with the market. I follow the price action, just fall in line. The next major catalyst will be coming from the earnings season, in my opinion. So 6 of these stocks, the heaviest weighted stocks in the market, are currently breaking out into stage 2 uptrends. So would you be leaning more bearish or bullish right now, understanding their significance to the broader market? For me, I'm definitely leaning more bullish. When you pair that with what we're seeing in the Qs and the current oversold levels in the broader market, we could at least expect for some sort of nice relief bounce. The FNGU is basically all of these stocks paired into one index, and you can see that it's moving into stage 2 as well. So overall, based off of that, my current bias is definitely bullish. Let's move on to some of the names that I'm watching. And these are all names that are currently showing relative strength. So these are names that broke out ahead of the QQQ. Well, I don't know where they're at. Where did I put them? Bear with me. Actionable? There we are. Okay, so here's the QQQ. You can see it broke out on the 6th, so Friday. Here's XPO. It broke out on Friday, so it's at least showing the same strength as the broader market, because keep in mind, the QQQ is a basket of stocks. So if the QQQ is breaking out on Friday, that means the majority of stocks are breaking out on Friday as well, because it's representing all the stocks within. DraftKings, actually fairly weak. You can see it's lagging the market, but it is at a pivot point that we could really start to see momentum. It's above the 50 moving average. These moving averages are starting to really tighten up and push and move to the upside. And with this downtrend line, if we could break through this and the downtrend line, we could see a lot of momentum come in. That also is the gap resistance. Meta, you can see it's already in that, or actually broke out with the QQQ, so it's right in line. Now AMD, this is ahead of the game. This is one that has been showing relative strength for some time. It broke out of its base back in late September, so over a week ago. So it's leading the market. Why do we want to be in stocks that are leading the market? Because when the market does eventually reverse, it's more than likely that these names are going to see the largest gains in terms of percentage. So we want to get in line with the strongest names, because I don't want to be in a stock that's lagging. Because if you're in a stock that's lagging, you might make some money on the rally, but you'll make a minuscule amount versus if you were in the right names and stocks that were showing relative strength. I'm talking, you could have a maybe if you're in a laggard, maybe you make 20% on a contract. But if you're in a leader, and I'm not exaggerating, you could make 200, 250%, because institutions are showing more interest in those names, so they're likely to see more appreciation. So here's APL, XPL. Let's take a look at the daily. You can see it's breaking out of a nice base here. This is about almost a 67-day base. So the longer the base, the more time that market participants had to get involved with it, the more people that stand to lose if we break out or if we break down. So we're likely to see a very strong response if this breakout sees continued upside. So if we, let's say, clear the high of Friday on Monday, there's likely we'll start to see a lot more momentum enter the stock. So I would definitely be interested over this high here, with your stop loss being low of the day, or if you want to give it more room, which I'd be careful if you're trading an option, you could use a close below the 10 exponential moving average, which has previously acted as support. So it's at least showing that at one point in time, it acted as a supportive level. If it never acted as a supportive level before, I would be a little more careful because it may not at all. So break over 78.5, could look for potential entry here. DraftKings over that 30 level, and really the profit target for this would be right around the high of this wick here. So you have a high volume reversal candlestick, which means there's a lot of supply here, and that's going to act as a resistance level. So you would want to really clear. You want to get. I'll kind of look to scale out as moving into that high, because it's really the high where you start to get the most resistance. I would still be. This is not my first pick, DraftKings, by the way. It's definitely weak versus the rest of the market. Meta, very expensive contracts. Not sure if this is something you entertain. Also has earnings in 3 weeks. That's not too much to worry about. But this kind of has free reign up to about 325. So when it comes to handling names like this that have already started their move, the best time to enter would have been here. The next best time to enter is going to be on the shorter term time frames when you get some sort of pullback. So that's what I'll be waiting for. Some sort of, let's say, uptrend to take shape. Otherwise, you got to be careful. Maybe pulls back to the previous resistance, and that's where you look to enter when you break over this high, giving yourself a higher high. So exactly how we handled Apple. We saw that Apple broke out on the 5th of October, and I said in the Discord that I want to wait until price retests the previous resistance level. Retested it a little more than I would have liked, but it then did break higher, giving us a higher high, a successful retest, and we entered there. That's something I would do. That would be a similar approach for Meta. Let's take a look at AMD. AMD, powerhouse here. Nice break through the 50-day moving average. However, I know the volume's higher than normal. It's really not as high as you would like to see when taking out such an important moving average. You want to see, I mean, look at this. It broke above the 50-day moving average here with more volume than we saw. And then the following day, it dropped 9%. It was on earnings, but still. You want to see a lot of power through that 50-day moving average like this. But it could work. Once again, just like Meta, I would wait for some sort of pullback on the shorter term time frames and get involved there. So here, some sort of pullback. The market had a very big move on Friday. There's going to be some short term profit taking that we see likely early in the week, unless there's more. We might see more the momentum continue into Monday, but at some point next week there's going to be some sort of profit taking. You're going to see some supply enter the market, and there's going to be some normal pullback action. It will likely be when the Qs run into the 50-day moving average. We also have Palantir. This is a nice one here. You could look to enter here, right above the high of this candlestick. So we pointed out in the last session that we have a high volume rejection candle here that coincided with the one on 8-9. So really why the highs of these candlesticks act as resistance levels is because a lot of supply entered the market at this point in time. So it wasn't surprising to see price get rejected on the 29th running into that resistance level because of the amount of supply that entered on that day. Look at the volume. So whenever you have a high volume close on a big trend bar like we had here, so one with range expansion and big bearish body, consider that to be a resistance. Just like if you have a big bullish candlestick with heavy volume like this, This should, if the bulls are truly in control, this should act as support. It should hold. You wouldn't really want to even see it come back down here to test it, but these levels should act as support. So we want to clear 1690. And once we clear 1690, we could see maybe moving up to 1803. But we're going to want to wait for a pullback. Unless you're a more aggressive trader, I would probably wait for some sort of flag or consolidation on the short-term time frames. TTD, same deal. A little late here. I don't think I would get involved. Bill, we broke through the downtrend line. So going back to our learnings of areas of convergence, we broke through the 50-day moving average, which previously acted as resistance. It also gave us a higher high, and we cleared the downtrend line. So this is a really nice move that we saw on Bill Friday. And it's also something to point out is that you could see there's a variety of different stocks that had huge moves on Friday, which is exactly what you want to see whenever you have a follow-through day, which we discussed earlier. You want to see stocks having large moves up on big volume. And when you do, it kind of just gives added confidence that this follow-through day will work. It will have more significance. It will have a more significant move up. This one, when we had it on the 29th of August, there was really no stocks that were breaking out. It was more so just a move supported by the mega cap names. So Apple, Amazon, Apple, so on. So Bill, really guys, there's a lot of these names. We just need to let it consolidate for a bit and then break higher. So ideally, you have Bill maybe retest that 50 and then break higher, look to enter there. ZS, well, this is really, I think, only for shares. Yeah, it's only for shares. But if you could break the high of this right here, bulls would definitely have some control there. However, I'm very conservative. I would definitely be waiting for a pullback. Crowd, same thing. Beautiful move, huge volume. All the cyber security names took off on Saturday or Friday. PNW is another one. So ZS is once again security. So this sector, this industry is definitely finding some love. And once again, this was a leader. This was leading the index. So it's not surprised to see these names breaking out of their bases and making the largest moves when the market did actually reverse. Now, PDD, Crowd, and ZS, I'm waiting for pullbacks and all of them, some sort of flag to form, something like this, and that's where I'll look to get involved. You can see they're a little stretch from the moving average right now, so likely what's going to happen is you see some sort of consolidation as the moving averages catch up, and then it will break higher. That's really my game plan for next week. We have a bunch of open positions. A lot of them we've already trimmed, some of them. Others, we're looking for that first price target, but overall, we're in great shape. The best time to have gotten involved was right when we were resolving out of this base, right when things looked like they were starting to turn. And the way we have the confidence to do that is by studying the market internals. It's by understanding market structure for what it is, etc. So that's where I stand right now. I hope there was a lot of information packed into this video, and if any questions at all, feel free to reach out.